get it fast. GizzyCredit. GizzyCredit.
We're live on el YouTube. Estamos, papito, your boy GizzyCredit here.
GizzyCredit.
Alrighty, that's enough for the theme song. Got you people on YouTube Live and YouTube and Facebook Live as well. Thank you so much for tuning in. Hope all is well. Let me get you right there. Let me call my partner up. How's everybody doing? Over here chilling. How's everybody doing? It won't take too long to educate you guys. Now that you guys are home, getting ready to go out, 7 o'clock. Let me look at the live chat. Munch, I have student loans on my report that are closed. Can I remove with the $99 system? Munch Meech, you're going to get your questions answered today on that topic, okay? So let me get John on the phone.
Hello.
Hey, John. It's Gizzy. How you doing?
Good. How you doing?
Good. Over here, getting ready. Turning off this AC.
What's that?
Turning off the AC.
All right.
Alrighty. So we got a couple of people on. I got a couple of questions already. What's good? Eastwood. Ospina, I'm working. Amanda, I'm from Kissimmee. What's up, Kissimmee, Florida? I got some people on Facebook. Will do. Okay, got somebody who's going to refer us business from Baltimore area, John. She's a real estate investor, and she's been watching me for a very long time. So right now we got about 19 people on the line, and they all want to see, hey, everyone, what's up, Jimbo? They all want to know, because I created the thumbnail about the topic we're going to talk about today, which is how to remove student loans and them not garnishing your wages. And I know that there's a couple of garnishment things that can happen to a person, not just student loans. Am I correct? It could be another type of garnishment.
Yeah, I mean, they really kind of just go for whatever, the easiest path to collect is. So if you're somebody that's employed in a standard, employee-employer relationship where you're getting a wage of some kind, they can go after your wages up to a certain specified amount within that state. It's specific in that state, but sometimes it can top out around 10% of the gross amount of the wages. If somebody makes $5,000 a month, it could be, depending on the situation, it could be, $500 a month additionally that comes out of the garnishment. Sometimes it's more if you don't fight it. They can also take it out of your income tax check if you don't have a wage, but you constantly get money back every year. I've seen that happen a number of times. In some cases, they can just go in your bank account if they get the judgment to garnish, to be able to just take it. So the reality of the situation is that it's imperative, because what ends up happening is, especially with the school loans, a lot of people end up just kind of kicking the can because they're not entirely sure, and they're starting to wise up to it, that you're just not entirely sure that it's not like your other standard type of debt. Because a lot of people, that have credit issues, debt-related issues, will just try to ignore them and treat it like out of sight, out of mind, and let it just go on and on and on in language.
I mean, yeah, correct.
Yeah, and then ultimately what ends up happening is, over the course of time, if you ignore them long enough, if they don't take you to court, that statute expired, and if you don't use your credit, it no harm, no foul, right? But then there's some instances where people will take you to court, and then that's a different conversation. But in this case, people for the longest time had tried to think that they were like, typical creditors out there, and they ignored them. And I'd say about 3-4 years ago, the Department of Education, Navient, who is the largest provider of these loans, finally put their foot down, and they started to kind of force people to the table. And in doing so, they did it by, basically going in and not stealing, but taking your income tax money in an effort to pay, and kind of force you back to the table, or starting to garnish your wages. And in all those situations, they send a letter out like, listen, if you don't come back to the table, we're going to start taking our money. But people, like usual, just ignore it. And then what happens is they wake up one day, and one day their check was garnished, or one day they go to get their income tax check, and they're trying to figure out where that money went, and that money went to the IRS, and they're chasing it around forever, and they're not ever getting it back. So in situations when that happens, it's a fairly significant process, which we've done a number of times now to kind of get it out of garnishment, because typically you have to do it through, they'll send it to a collection company to do it through, and you have to kind of work it out to where you get on specified terms. And typically there's a certain amount of payments that need to be made of that on time before they'll take the garnishment off. And then you can kind of graduate back into the Department of Education. Now, the luxury right now of everything that's going on is the fact that the Department of Education, regardless of the fact that they have such a high default rate, which I think is right now about 25%, roughly, they're doing everything because the other 75% pays comfortably for the 25% that's in default. They're just trying to do whatever they can to try and get these loans back producing, meaning, they'll set you up with, if you can't afford it financially, and because they'll take a full financial when you call them up. If you can't afford it, they'll basically back into, what you can afford, and they'll adjust it down. That doesn't matter if you have $10,000 in school loans, you have $150,000 in school loans. I've seen it happen in both instances. And in both instances, you could easily see the payment get down to single digits. And then that will be considered pays as agreed going forward. And each year, whether it's the income sensitive or income driven program that they have, there's a number of them nowadays, all with different objectives, but the same overall objective is to just get you paid as agreed, and so that they can lower those default rates.
Correct.
And get more and more people on board. So, I mean, a lot of people still haven't kind of bought into that idea, realized, that they still need to do it. We're still getting clients that are behind consistently on their school loans. Yes. But I have noticed, going back maybe 5-6 years to date, you're seeing less and less. When we first started doing this back in,
2012.
To even before that, the big issue at that time was people that were coming out of the other side of the financial crisis, right? Where everybody was in real estate at that point. Everybody was in real estate at that point, and they got, they were over mortgaged, and a lot of them, the big issue then was foreclosures, right? Going back then. And then, that worked itself through the system. And then coming about 5-6 years ago, it started with the school loans, and the school loans are still, I would say, of all the clients that come through, still the biggest and most consistent issue. And with that in mind, it's a situation that, you're starting to see work its way out, but there's still people that don't take it serious and unfortunately ignore it until it smacks them in the face, and, they're kind of left with that kind of a situation. But it is fixable, and that's the purpose of what we're talking about, right? So even in the worst case scenario, it is fixable, and it is capable of being put back together, and it is a situation that can get done within like 2 months. After a certain number of payments to them to lift the garnishment and get everything back on track. But to get them modified is even a significantly quicker process than that.
But even if people are trying to get financing, they're still looking at your credit report. And even if I spoke to a person today, as a matter of fact, I think his name is Jimbo from Flint, Michigan. And he has a student. He works for the government, and he says he's in the program where he doesn't have to pay, like the job pays the student loans for 10 years, but those student loans are still on his credit report, and it's over $100,000. And he said when he went to go and get a mortgage, how they didn't take consideration that his company was paying, right, the student loans, or it was coming out of his check. And they were like, oh, how does the equation work with when you go and get a mortgage and they take into consideration your student loans?
Well, two things. One, the reason why they were still taken into consideration is because it's indefinite, right? Like, you have to work with a lot of these government jobs, depending on what they are. You have to work there for a certain period of time for them to agree to, right? So he could change his mind in 3 years and go switch jobs, and he would lose that perk, right? And you're going to have a mortgage potentially for 30 years. So they're not going to commit to that until those loans are paid off, because obviously it's subject to change. But what you're talking about is in the school loan, when you're applying it to the mortgage process, what ultimately ends up happening is, even if you do some sort of an income-based or modified scenario, let's say we're talking about this the last one, if you have $100,000 in school loans, the typical payment on 100 grand is probably like 1,500 at an average, school loan rate over the typical amortization. So even if you got that payment down on your terms, pays as agreed for $10, what ultimately they're going to do when they're underwriting the mortgage is they're going to use the standard payment, because the idea is that if you ever fall out of that program, then you have to revert back to the standard payment. They have to cover their downside, which is the worst case scenario, which is the $1,500. So it's great that the Department of Education offers it. I think they absolutely had to. So I don't think it was something they were doing a favor for people. I think they were kind of forced to do it because they overlend in that side of the table. But more importantly, it really hinders people like dramatically on the mortgage side, because even though they offer that program, the way they're underwritten now, unfortunately, they don't get the benefit of that. And honestly, that's as a result of coming out of the financial crisis in like 2011, 2012. They weren't counting if you were deferred or you were forbeared on your school loans, which everybody was at that time, because it was just an influx of people coming out at that time of school. And this is when a lot of the school tuition numbers back in 08, 09, 010, 2010 really started to balloon. If you go back and look at the numbers, the school loan, the tuition rates really started to skyrocket through that period, and they've continued to skyrocket since then. So that was kind of the first enclave coming out at that time. And in doing so, people the mortgage companies weren't even factoring in the deferred or the forbeared loans.
Could that have been an economic thing, though? Don't people usually just start going back to school when it's a recession? Isn't that a popular thing to do?
It would make sense to me, right? I mean, I haven't heard that. It makes complete sense, though, right? Because if there's not a lot of jobs, the low hanging fruit to be able to support yourself and go back is school loans, because school loans, especially the higher education ones, are significantly higher. You have cost of living built into it. So, I mean, if you don't have a lot of debt, it's a way to continue to kind of work through and kind of work a career with still getting money from the government. The problem is you're just drowning yourself in further debt, though, right? Debt that gets more and more expensive and gets more and more costly each time you go back, which, again, the people that are going to school now are seeing, and they're unfortunately feeling the heat from. But I think that, the point I was trying to make was that now, as a result of those loans that they originated and then ultimately got burned on, and when I say that, I mean all the big banks and then ultimately Fannie and Freddie eating them, is they came back now and said, you know what, from this point forward, what we're ultimately going to do is we're going to count the worst case scenario on these student loans, and whether or not they're paying that exact amount as a result of the new programs, which are essentially modifications, it's still going to hurt them, and it's still going to have to be something that they have to account for when they're trying to buy a house. So if they do have to pay it, it's going to have to be built into the recipe. So, I mean, it is what it is. Unfortunately, there's really no way around it at this point unless something changes. And given the fact that they were already burned and it was recently, I don't see it changing and reverting back anytime soon.
I mean, we have helped people who have $20,000 in student loans debt to having. There's always a number that people tell me that it's like when we help out doctors. I mean, they could have over $150,000 in student loans.
No. It's way higher. Doctors is way higher than that. Way higher than that. Like legit doctors, you're talking about, you're talking medical school is I mean, even grad school, somebody went to a full on grad school, law school, et cetera. I mean, that you start getting into the multiple hundreds of thousands of dollars in school debt, right?
Yes.
But if you do the numbers now, the average tuition of a standard score right now, I think, is in the 50s, right? I think it's like $55,000 or $57,000. So,
That's
I mean,
crazy.
do the math on 4 years of that. That's $250,000. I mean, the new generation of student loans is going to be just an obscene amount, and it's going to be something that eventually is going to have to give, right?
Yeah.
Because real estate prices don't just continue to climb, unfortunately. And as a result, inflation is essentially flat, and it has been for a period of time now. So I don't understand how, without getting into too much of an economic scenario here, I don't know.
No. Get into economics, because we got some people that love that stuff. So, I mean.
Yeah, so, I mean, I don't understand how school loans and the tuition of the school loans continues to just blow up the way it has been while everything else is stable, right? I mean, it's kind of like it's because of the fact that if you look at it, another comparable lane is auto loans, right? The average new car purchase these days, the average cost of the new car purchase these days is $38,000. right? $38,000 is the average cost of somebody going to buy a new car these days, right?
Yeah.
So if you do the math on that, that basically over 60 months at a reasonable rate of roughly 8 to 9%, that's approximately an $800 payment. Okay. The average wage income in this country, I think, is somewhere around 30, 40,000. So do the math on that. After taxes, essentially on an $800 car payment on a, and I'm not judging. I'm just saying it just shows how out of whack certain things are, right? And I'll back into where it's coming from, though. If you're somebody that makes $35,000, let's say $36,000 a year, and that's $3,000 a month, times that by, after 20%, 25% taxes taken out, you're roughly clearing, I don't know, maybe $1,500. 800 of it is going to well, maybe a little more, $2,100. 800 of it's going to your car loan. So now you got $1,300 left to survive on for the month.
And
that's
you see
crazy
that a
to
lot.
think about. But the reason it happens, though, just so you understand, is all of these areas, and you've seen it in real estate in the past, you see it sometimes in stocks, you see it in other asset classes, is the areas where the liquidity is the most, right? The lowest hanging fruit, where it's very well capitalized and just overfunded, are the areas that you see just take off, because there's a constant money supply supporting it. When you go to school loans, the Department of Education, no matter how many beatings they've taken on these loans, continue to lend. They lend blindly. They do no financials to lend you money, right? Yeah. As long as you have a pulse and you can put together a thought and declare a major, I mean, you can get into school these days. So as long as that money flow continues to pump into there, the schools are going to take advantage of it. They'd be crazy not to, right? Correct. They'd be crazy not to continue to raise if the money's there, right? And and all of them are falling in line. I mean, just look at the tuition rates of the last 5 years. 5 years. Don't even go back 15 years, because you'd probably cry if you did. Go back 5 years and see how much the tuition has gone up over the last 5 years. And then go back to auto loans. Right? Same idea. It's the low-hanging fruit. It's the area where the banks can lend very aggressively. Even with a high default rate, they still make a boatload of money because the interest rates they lend are extremely high, right? Areas that they can't lend that high in mortgages. They can lend high in credit cards, but it's not fixed over the same period of time, and it's amortized differently. So in essence, there's a constant flow of capital that goes towards auto loans as well, which is why you're seeing it just so out of whack relative to some other asset classes that have stabilized, like property values and things like that, right? Yes. Property values are backed into through appraisals and all these checks and balances that went into effect through Dodd-Frank, right? So those things were put in place to protect the consumer. There is nothing in place as we all know, because we've talked about it with the dealerships, just how predatory that is. There's nothing in place to protect the consumer on the school loans. There's nothing in place to protect the consumer and the money flow with auto loans. It's just endless. And as a result, something will eventually give, because there's going to come a point in time, and we're probably going to get there very soon. Even if they do give these loans for $1, if you borrow $250,000, you only pay $5 back. At some point in time, something's going to give, right? And it's going to be the numbers, the financials on it. When those numbers stop working out the way they need to, is when you're going to start to see adjustment. Until that time, it's going to get, like it always does, it's going to get pushed to the very last second. And then there's going to be some sort of a corrective measure needed in order to get things back in line. I just think, though, that right now, especially with the school loans, to get to that point, I mean, we're so far along in this, and it's accelerated so greatly. I mean, you got to ask yourself, when's it going to stop?
Well, do you not to get all political, but do you think any politics will do something about this?
No, because I just want to put something. This is actually a really good question, and this is something that I think people need to understand. If you hear any of these politicians out there saying, like, we're gonna forgive student loan debt, et cetera, et cetera, et cetera, please understand that the total amount of student loan debt out there is like $3.5 trillion, I believe, as of maybe a month ago. Okay, so to think that, and that represents, I think, a rather reasonable percentage of our overall debt in society. So to think that somehow some presidential candidate legitimately is going to be able to say, you know what, $3.5 trillion, done. We'll eat it. We'll eat $3.5 trillion. Number one, it would never happen. Number two, there would be no way to do it. There would be no way for them to eat that, because that's on borrowed money anyway. Our government borrows money through bonds in order to pay, you understand, to lend out and make more money. So they borrow at 3%, they lend at 8%. It's like any other banking situation, right? They borrow on treasuries, and then they turn around and they, in this particular instance, they help support our economy. Plus, they lend on student loans. It's just the way it is. There's no way they could eat it. If they ate it, they'd still have to pay the 2 points that they're paying on the treasuries that they're borrowing. So there's no way it would ever happen. But you hear some of these candidates with, again, not getting out too political, but I just think it needs to be pointed out. There's just no way. There's no feasible economic way. Now, maybe somebody here, somebody there, but if you and I have talked about this in the past, you go back maybe 2 elections, that's always been the way to get like the millennials, right? To draw on the millennials is because they're so straddled with debt and there's so many of them, right? Is to, hey, listen, we're going to do away with it. And the assumption is they don't know enough about the economy at that point or care that you can manipulate their opinion, right?
Yes.
So the reality, though, is there's absolutely no way to get from A to Z. And if you ever watch, all it is an utterance that starts in the very early stages to draw them in, right? And then by the time the election's done or you start to wind down, you get near the end, it's not even talked about because it's not possible. There is no economic engineering anywhere that could allow that to happen in any shape, form, or fashion, like on a large scale, right? In the $3 trillion scale. It's just even a multiplier of that would be almost impossible to do. It would have to be on a case-by-case basis. And the luxury of these income-driven and income-sensitive programs that they have through the Department of Education is you have to renew them every year, right?
Yes.
So you go back in and every single year you renew them. Well, depending on the type of loan you took out, if you stay in that income-sensitive program for 10 or 15 years, then it's dependent upon the particular program that you signed up for originally. But if you stay in that program for 10 or 15 years, sometimes they allow you to forgive a lot of the principal. So there are isolated situations in those instances where you can forgive some of your principal, right? If you stay with their program and you do what you're supposed to do and you stay on it, the idea is that they're not expecting people to stay in that program for 10 years in a row, right? That's the idea, is that they're eventually, they might stay in for 3 years, 4 years. I just don't think they're counting on the general public to stay with something for 10 years, let alone 15, right? So they're saying, all right, you know,
well, people who buy houses normally stay in a house for 7 years and they bounce.
Yeah, that's what I'm saying. So that's what they're using. I guarantee you there's some sort of a formula there that they've arrived at, that they know that they're not going to be forgiving more than 1 or 2% of the loans, right?
Well, that's why you can't even go and claim bankruptcy on it either.
Right. Well, it's what I always say. I mean, when you're dealing with the IRS, you're dealing with the Department of Education. They have their own rules. They play their own rules, and it's just unfortunately the way it is. And you know, the good thing is that the Department of Education is being so flexible. But again, we talked about why they're doing it, because they're trying to get their, you know, they're trying to get these default rates way down, right? To get people in line, and they can slowly graduate them up, right? You get somebody on pay terms, and then over the course of time, the psychology is they get comfortable paying it, and then little by little, you start to inch them up. That's how the banks did it with modifications, right? The mortgage modifications, they did the same thing. You know, you get them into a modification, and then you slowly, over the course of time, figure out ways to start incorporating other costs in there to slowly start to pick the payment back up, and before you know it, the consumer's in a headlock again. So, I mean, it's the same idea. It's no different. But I do think that, you know, eventually something will probably give when it comes to these school loans. I just don't know when. And I think everybody's been looking for it. But again, I think it's when the numbers start to.
I mean, but just like you talked about modification, where they put the payment in the back of the mortgage loan, I'm seeing auto loan go to like 70 months sometimes. 60.
Oh, no. But see, that, again, that is as a result of how high these costs are, right? See, you got to understand, that goes back to what I was saying earlier about how expensive the new car cost is. The average new car is $38,000 people are buying. Wages have not got, regardless of what the media tells you, when they say wages are up, they're talking about like 10 cents, right? When the average car goes from 2017, right? The average new car 2017, the sale was like $34,000, and then it jumps up over 12%, and you go up in wage 10 cents, which may represent. Crazy. Do you understand what I mean? A pay period 10 cents, which may represent a 1% increase. Something's not adding up, right? And the people are eventually hitting a breaking point where they can't afford it. So what does the banks do? The banks turn around and say, all right, you know what? Instead of doing 60 months, instead of doing 72 months, we'll go 84 months. We'll go out 7 years, right? Which is insane, because after like year 3, cars depreciate so rapidly, right? And it's so rapidly. And then they continue to every year after that depreciate even worse. But it's the only way for the banks to stay in that and continue to turn that paper. Like I was saying, they want to be in that lane because they make a ton of money. And the only way to continue to turn that money over is to continue to find alternatives to stay in there and continue to figure out more ways to funnel it because of the high interest element that they can try and procure with most people. Based on the reasons that we've talked about in the past. So, I mean, it's all as a result of them wanting to stay in there. But you're right. They are going out of their way to try and figure out ways to extend the auto loans. What I find unusual, though, is with that being said, because they have changed. I mean, you can go back to 2014, 2015, and they just, in 2014, 2015 is when they just started instituting the 72 months.
Yeah.
Right?
Yep.
And then you got to.
But Jay, just I'm watching economic news and all that stuff. Back in March of this year and April, there was a record number of defaults in car loans. And
of course. Go ahead, finish what you're saying. I didn't interrupt you.
No. That's what I'm saying. That that was 2014, but yeah, people are still defaulting in 2018. 19.
Right. So understand, though, that's kind of what I'm getting at. So when you get to a certain point, if that default rate starts to exceed their threshold, right? Like, let me give you an example. Capital One, who's an alternative lender of every variety, right? Their default rates are significantly traditionally high, right? But they make so much money, just like the student loan companies, on the other 70%, 75%, that as long as they can keep that threshold within their risk parameter, they're comfortable, right? Because they still make money hand over fist, right? So they're fine with that. Now, the same thing goes for the auto loans. Yes, default rates were extremely high. And it really is tied to the particular article, because in those articles, they'll say, you see it a lot, and it'll be like the most auto defaults since second quarter 2017, right? Yeah. They don't really go back that far. They keep it normally within like a 12 to 18 month period or 2 or 3 quarters. But when you see the problem where it really starts to balloon and they start going back 3, 4, 5 years, and it starts to pronounce itself, then you'll start to see it be a problem. I think that the thing that we're dealing with right now, though, is on the auto loan side, and why the defaults are where they're at, is for the reasons I was describing earlier. If you don't make more money, the 2 bills that people pay first is the mortgage, right? In most cases. Your second bill in an average household is typically your car payment, in most cases, right?
Yes.
If you're not making more money and you were over lent to, which happens most of the time in auto loans because there's no income documentation, right? They don't make you come in there with your tax returns. They don't order a 4306T in order to verify and get tax transcripts. They do none of that.
Yeah.
So they basically just lend to you blindly, and as a result you get over lent to, and as a result the default rates are high. I think when those default rates get excessive to the point of, like I was saying with the school loans, their ratios and their risk parameters getting out of whack, is when you'll start to see it pull back. And I haven't seen any of that, meaning like I haven't seen the auto loans get more stringent on the lending yet. I'll know when it happens, because we get a ton of clients that come through, and I know what lenders are flexible, and I know what lenders are tight, and I know which lenders fall right smack dab in the middle as far as their aggressiveness is concerned. And I'm not seeing any pullback at this point. But eventually it will, right? Like when we start to contract as an economy, the areas that they're getting hit the most are the areas you're going to start to see them pull back. Like when the economy collapsed in 07, 08, or 9, whatever it was, the first area that they constricted their exposure, their liability, their risk measures were in mortgages, because that's where they took the largest isolated hit, right? We immediately reverted back to, pre-crisis levels where they wanted like 10 or 15 or 20% down. It was absurd. They completely reverse engineered it, so no house would sell for like 6 or 7 months, and it just exacerbated the problem. But what it allowed the banks to do was, it was an opportunity, because ultimately Fannie and Freddie didn't want to fund it anymore because everyone's getting stuck with it, and it allowed the opportunity for the banks to establish a new risk parameter that they were going to have to use for the near future. Same thing is going to happen now, but right now, while the economy's still humming and we're still in a good position, you're not going to see those types of adjustments because they're comfortable with the way they're allocated. Even if you're seeing defaults, even if they're over lending, even if all these things, you won't start to see the major adjustments until the ratios get out of whack, and that's not really going to happen until you start to see the economy contract or start to pull back. Which, who knows when that's going to happen at this point? I mean, everybody's been calling for it for years, and it's just still humming along. So we'll have to see when that actually transpires. And I think we'll get a better idea come the election time, because I think that'll give people a good idea of, who's going to be in there for the next 4 years and what their overall plan is going to be. What their focus is going to be. Obviously, with Trump right now, there's an enormous focus on the economy.
Correct. I mean, I sent you a pic talking about those car loans. Of the Wall Street Journal did a article. Lenders verify income on only about 7% of all loans since 2017, according to the Wall Street Journal. That's insane.
And I would question even the 7%. That may just be for formality. I haven't ever seen a dealership where they've asked for income documentation.
And then they go, an 809 car payment, 660 income. How dealers make the math work? I mean, what you got to put that you making $200,000 or something.
Yeah, for sure. I mean, there's people. Listen, there's people that have like 3 cars, and they're like $350,000 cars sometimes. You say to yourself, you can't find any discernible income out of that person, right? And Correct. You're saying to yourself, how did you get this car? How did you get all these cars? First of all, why do you have all these cars? Second of all, how did you even get all these cars, right? And it's just smoke. That's why normally when the economy pulls back, the area that gets hit the hardest is the area that's the least regulated. And the area that's the least regulated, least from a fiscal perspective, is the school loan area, and it's the auto loan area, right? Credit cards get hit, but credit cards get hit in good times and bad times. It's not isolated to just bad times. When the market starts to pull back. And the good thing is that now, if the market does pull back, the real estate market's a little more solidified, given that there's none of these alternative. Well, a majority of the loans out there in civilization right now, mortgage loans, are all heavily documented, right? So the Correct. People that said they made, it's what they made. So if things turn, it shouldn't be anywhere near what it was before, right? So that's good. So there's some protection there, and obviously that's a bank's largest capital outlay is on the mortgage side of things for the most part. So, if they're isolated to a certain portion of the portfolio goes towards auto loans and that hits the fan, it is what it is. So they know this though, right? I mean, they know that there's no documentation among these. They know that they're stuck trying to, rely on these dealerships that are anything but, functional, right? I mean, these dealerships are.
Well, not only that, Jay. I mean, we could go more deep into the conversation with car dealerships, because we haven't even talked about inquiries and how many inquiries a mom and pop dealership will run compared to.
Listen, it's not even a mom and pop. I had a client today from Louisiana. He had a 722. Okay, 722. Now, him and his wife he's a truck driver, and he was getting a hot shot truck, right? Like the double wheels in the back, something that can carry the loads like a big bed.
Yep. Right? Semi truck.
722, right? Yeah. So for any matrix possible, should be more than justifiable to get somewhere in a reasonable rate. Went to the first dealership. First dealership shot out 37 inquiries on a 722.
Nah.
37 inquiries. They called me today and they were like, listen, we did this without talking to you, but we need help with the inquiries now. This place shot us out to 37 places. And I'm like, listen, you got to do something about this. It's ridiculous. You know what I mean? You can't just eat that. I mean, what happens if you don't? What happens if you don't have me to help you, right? Like if you're just an average consumer and you're 722 and you go in there and all they're doing is picking at a yield spread. That's those 37 inquiries, right?
But you remember when we used to see 92 inquiries on some of these files? I mean, hilarious.
I saw one yesterday with 100. 100.
Yo.
But here's the thing though. If it's an auto dealer doing it, I mean that's criminal, right?
Yes.
That's criminal.
Yes.
And in this case, they left the dealership and they kept running it.
Well, that's the thing that happens that I get a lot. Like I left the dealership, they'll tell me they'll call me, and I'm like, what? You gotta tell them not to run inquiries anymore.
You shouldn't have to tell them that.
Oh, that's true.
If you're not sitting across from them anymore, then that deal did not go through. There should be no reason they should keep knocking on that door, man. That there's nothing to talk about. So, I mean, you start getting into like criminal behavior, right? Like Correct. that's all that you got to understand. Again, to go back, when you're a 722, any auto lender will lend to you at a 722, right? That is not an opinion. That's a fact, right? So if you're pumping out to 30 different lenders, that is because you're trying to build in a steeper yield spread to put more money in your pocket. And by yield spread, I mean whatever rate you get quoted on the commercial side, you're going to build in a rate between what you tell the consumer. So if you pump it into your system and Bank of America comes back and says, we'll give Michael a 2%, a 3% rate, you turn around to Michael and say, our dealership will lend you at 7%. There's 4 points in the middle. That 4 points gets calculated off the loan amount of the car. So it's a $50,000 truck. They make an extra $2,000 on the deal, right? Now, you as the consumer are paying thousands and thousands, tens of thousands of dollars, 20s of thousands of dollars over the course of the loan over because of that $2 extra grand they made because it's extra 4%. But that's all that individual is doing, right? I mean, it's a conversation that I could have forever.
I know.
I'm disgusted by auto dealers and how they operate just because of how many times I've gotten into more screaming matches with clients. Not with clients, with like clients in the dealerships where they're calling me and saying, this guy, blah, 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 blah. And they get me on. I got in more screaming matches with dealerships and sales officers and finance managers at dealerships than probably any other industry that in the finance realm, because it is the only one where there is zero regulation. The finance manager needs no license. The salesman doesn't need a license. There's no checks that are done. Anybody can come in and do it. I have no idea how they got to that point. I have no idea how there's any area of finance associated whether you're allowed to have that, because modern day, that sounds ridiculous, but somehow there is, and every single day people are getting taken advantage as a result. I'm telling you, I see this stuff every single day.
That could be another video on its own. And we've been talking for 36 minutes. I got a couple of questions that people have. If you don't mind, if you want to just finish up on the student loan side of things, go ahead.
Well, I mean, I think on the student loan thing, the objective that the purpose of this was just basically to encourage people, to not wait until the last minute, because you can avoid it. And the avoiding of it is a process, not a long process. It's a relatively quick process. Might take a couple weeks to a month. If you wanted us to do it, we do it for our clients. We charge a fee, obviously, to do it. But, we basically take it through the modification and everything like that. We get you on pay terms. And then, you're basically home free from that point forward, whether you're in default or not. You don't need to be in pay to degree to go back for a modification of some sort, whether it's income driven or income sensitive. So if that's something that you need help with and you don't want to wait until you get smacked in the face with a garnishment, you're not paying attention, then I strongly suggest, and you don't want to do it yourself because you don't feel confident enough, or you're just not, you're just not one of those DIY type people, we'd be happy to help you. If you are somebody that is way behind, and you started getting the garnishment letters and you know that you're probably right then and there and you're weeks away from probably something like this happening, then I would strongly encourage you to reach out to us, because that's more work and that's more.
Let's get into that example in a little while when we helped out a customer with the garnishment.
Okay.
You want to get that?
So,
let me answer this question right. If you want to finish up, or I want to get to an example of how we help someone.
Okay. So then let me just go through this, and then we'll get to the questions after. So
okay.
A client got started with us for credit repair. This was, I don't know, maybe 2 months ago, and maybe 3 months ago. And in that process, the client, I think we were only into it for
for like 2 weeks, probably 2 weeks. It was 2 weeks.
We had just submitted this fee. It might have been like 10 days, 12 days, something like that. And I remember it was a Friday, and he emailed us like, as he should, completely just floored. He was like, I can't believe this just happened. But, because you're waking up, you're looking at your account to check your money because it's Friday and your company's dropping money in your account.
You imagine how that feels?
I can tell you, he was in a, like most people would be. It's completely understandable.
Right.
So, he reached out. We were able to, which is good. And it's this particular collection company that was handling it on behalf of Navi and Department of Education, et cetera, moved quicker than most. So it was actually really good. So that first day that we got started, we were able to get all the documentation over. We were able to establish a new payment term relative to his finances, which was significantly less. His payment would have been like $600-700 after we adjusted everything out financially, because he made a really good living. After we adjusted everything out financially, I think his payment was like $120, and that was just within the collection company. So when you do the workouts on the garnishment, they don't give you all of the programs that you would see with the Department of Education or something. So once he's got another, at this point, we're able to get him in and out of the garnishment in Well, that first month, they allowed us to make 3 payments. So you have to make 5, depending on the lender and the collection company, you have to make between 5 or 6 payments to get out of the garnishment. They let us do 3 in the first month. So that first day, we set everything up, which was awesome because the guy I was dealing with over there moved quick like me. We were able to set up 3 payments in that first month. Second month, I think we were able to get 2, and then we did our last one in November, and then he was out, right? So now he's got another, you have to stay with him for another 6 months because it's got to be 9 months total. So he'll make that 120, which is already imputed and significantly diluted payment to his original payment.
Correct.
For another 6 months, then he gets shipped back to the Department of Education, where we're going to get that payment lowered even more because there's a bevy more options over on the Department of Education side relative to where his financial picture is to knock that number down even more. I bet we get that in the 70s or 80s. This guy makes a very good living too, so it's not like he's not like somebody that he makes a very good living.
He makes good money.
Makes good money. So the point I'm trying to make is that it's not just set up for people that make a small amount of money and are overlent to. People that make a large amount of money often lever up, like we talk about a lot. They lever up over the course of their life, and then when it's time to fit in your school loans, there's no room for it. And, in this particular instance, we were able to get everything, the garnishment in and out, all the paperwork done and everything like that. It was very, very quick. He was in and out of it 2.5 months. And now he's just on pay terms for another 6, and then we're going to get him lowered after he gets sent back to the Department of Education. On the contrary, when you're dealing in a situation where you can get out in front of it before it happens,
correct,
that process typically takes about 3 weeks, roughly, give or take. And as long as we can get all the paperwork together and get everything over, and then, you get your approval and it kicks in immediately. So, I mean, it's a fairly streamlined process, and they have to do it because, again, going back to what you said earlier, you're talking about $5 trillion worth of outstanding loans, of which
correct,
roughly 25% of them, if we're just using rough math, are in default or nearing default. So just do that math. I mean, they need to get these performing. So they're just as motivated. So, I mean, that's an ideal example on the garnishment side, though, because that's the side where people feel helpless, right? I mean, because they get into a situation where, oh, crap, now they have their claws in your side and you can't get them out. And there's no way to get them out, right? I mean,
but Jay, do you have to be served to get the garnishment, or can something in the mail come?
Again, I go back to they are not a typical creditor. They can do whatever they want. When you're in default with them, just like the IRS, they reserve the right to do what they need to do. A typical creditor, to like a collection company, creditor, et cetera, an average lender would have to go the regular channel, take you to court, get the judgment, exercise on the judgment, which they could do with garnishing your wages, going in your bank account, et cetera. Department of Education is not on the same page. Not in the same. They are in a much lower league than them, meaning they don't have any obstructions. They can do what they want. Now, obviously, you have to be in default. And obviously, you're borrowing money from the government, right? So they don't just go around aggressively trying to figure out ways to garnish people. It takes a long time to get to that point, right? These aren't people that are late for 4 months. These are people that haven't paid for years, right? And just haven't made any intention of paying. And the government finally says, we got to get them back to the table. And this is how you get somebody to the table, right? To get them to figure out a way to get paid as agreed. You take their income tax check, you take their wages, et cetera, until they come back and they provide you all the information you want, and they get their default rates down, and everybody's happy.
Is this the same thing? Someone on the YouTube, Curtis, said, plus they start talking to your employer, which hurts you. But I believe at that point when they're talking, I'm thinking they're talking about garnishing the wages already.
No. Here's what happens. When there's a garnishment, they send over a notice. So they talk to your employer. Absolutely. They have to talk to the payroll department. The payroll department is the one that has to hold the money, right? So they send over the garnishment to the payroll department. I mean, I don't know what kind of privacy laws there are as far as the payroll department talking to the rest of the company. I'm sure there's got to be some sort of privacy law there. I mean, I can't imagine that they can just go around blurting everything in this day and age with how sensitive our society is. But they do. The minute they get it over, they send it over to the accounting department. The accounting department has to garnish. It's not like an opinion, you know what I mean? They have to do it based upon what they receive relative to the order that they get, and they follow it, So there's nothing they can do about it. Once that garnishment comes in, they have to honor it. Just like, when they take the income tax check and
or child support.
What's that?
Or child support?
What do you mean child support?
Child support does the same thing. They go talk to your lawyer, right?
Yeah,
I mean, they go talk to your job.
Child support's a little differently though, because you go to court. What ends up happening with child support is, whether it's agreed upon or it's the mother goes and the father does not go, is the state sends through and identify. It's the state that implements it, right? So, I mean, they'll go in and identify. They'll get the employer. They'll find the employer if it's not provided, and they'll garnish it that way. The state will do it, though. And that's based on a court order, though. You understand what I mean? So the court order is what allows them to send it over, and the court order is what ultimately has to be honored relative to the child support. So it's a little different, but it's generally the same idea.
Okay. So I got some questions here. By matter of fact, people who are on Facebook and on YouTube, if you could kindly just click on the like button, just like it. Thank you so much. Or on Facebook, if you could just like it and love it, that will really help us out, get more reach for people to be educated and reach out more. That's the best way you guys can help us out right now, is by liking and sharing this content. Thank you so much. Let's get to the question, which was a political question, because we were talking about politics. I got a question. Do you guys think Bernie Sanders' plan or some form of it will go into effect? Do you think people should hold off paying their loans?
Bernie Sanders' plan as far as figuring out a way to admonish all the student loan debt, is that the question?
Correct.
Yeah, I mean, I think I talked about that at length. There's not a chance. Listen, again, Bernie Sanders is heavily loved by millennials, which goes back to exactly what I was talking about earlier, which is the fact that the reason why they say that is because there's so many millennials in our society now, right? And they're so different than previous generations, in that they're very assertive. They all have opinions, and their opinions are all like on things that are outside of just boring things, right? They're all these political, et cetera, et cetera, et cetera. So Bernie Sanders is awesome for them because he appears harmless, right? And all he keeps talking about is stuff that caters to millennials. He knows now that the millennials is his
he's
bread
very
and butter.
popular, and he was what? I think that this past quarter he raised $35 million.
He raised the most. Yeah, he raised them. He raised $34 million. But again, he raised $34 million on it was like 70,000 donations, which means everybody donated like $30, which again was like all millennials, right? So you're talking about, if you go back and identify how many donations there was that made up that said 34 million, it's all millennials. Which, look, there's absolutely nothing wrong with millennials. The point I'm trying to make is, going back to the question, is that if you do the finances on the number one, you shouldn't just intentionally not pay anything. Like, if you can afford it, you should pay it. If you can't afford it, then I think the income-based, there's so many programs out there in the Department of Education that you can utilize that you can pay, right? I mean, just get it adjusted, whether you ask us to do it. I mean, it is a process, but it's a process that's not difficult to do. You don't have to be behind to apply for it. You don't have to be late on it in order to apply for it. If you're nearing it and you can't, I mean, there's certain catches to that. Like Sallie Mae is very difficult. Some of the private loans are very difficult. But most people have borrowed from the Department of Education and Navient, some of the larger ones. But in most cases, they're all very flexible and easy to do. But I think that the idea of just completely getting rid of these loans, there's just no way. Again, to go back and repeat, there's close to it's between $3.5, $3.7 trillion worth of school loans out there. Our national deficit is it's a rather significant multiplier of the overall deficit, right? And there's absolutely no way we borrow us as a government, we borrow money through treasuries, right? Whether it be short-term treasuries like the 5-year, long-term treasuries like the 30-year. We borrow to help fund our economy, to help fund our country, but we also borrow to lend. So if we're borrowing at 2% from an individual that right now, which is approximately what the 30-year, I think, is 2.1, maybe close today, somewhere around there, 2.1%, and you're lending to a student at 6%, right? And then you turn around and somehow, some way, you're going to say, all right, guy, you know what? That 4% our government was earning on that, right? Because it's a typical banking model. You borrow a certain amount, you lend a certain amount. The middle of the yield spread is how you profit. The money that we were making on that, we're going to get rid of that because Bernie Sanders has somehow figured out a way to do this. And we're going to forgive all these loans, and we're going to pay all the money that we borrowed, right, to fund these loans. We're just going to eat, which is $3.7 roughly trillion. And let's just give them the benefit of the doubt and say that they borrowed it at 2%. I mean, do the math on that. Imagine if interest rates start going up too. I mean, it would be crazy. It would be absurd. There'd be no way. There's no financial engineering that you could ask anybody. If you really dig into this topic and you look at every other scenario, like anybody's ever touted the removal of total school loans, you will not find a real economist ever attach themselves to that idea because it's not realistic. There's absolutely no way to financially just remove $3.7 trillion worth of school loans. It's not possible. The carnage that would come as a result and the damage that the government would do to itself would be unsustainable. It would be insurmountable. I mean, just think about the money that's made on them. I mean, just you remove just the profit from it, let alone the loss they would have to take on forgiving it. I mean, it's just, to answer the question, I don't believe that's a possibility. I don't think it's ever going to be a possibility. I don't think it's a reality. And I think, unfortunately, the purpose of that conversation is strictly to manipulate the millennials, because the millennials are the ones that are going to be most affected by it. And it's the most, if you've ever seen these studies that get done, it is the most concerning topic for them. With all the polls that get done, that's the thing that they're most concerned about is the school loans and debt. Yeah, exactly. So he knows exactly what he's playing to and the audience he's playing to.
So John, if the question is, do you think people should hold off on paying their loans? Can you defer them?
Every loan, well, not every loan, but most loans have a certain amount of deferment and forbearance baked into it, right? So obviously, if you're still going to school, you're not going to pay and you have no way of paying. So that's why they do that. When you come out of school, you're just trying to develop cash and make money, right?
Yes.
And just start to develop some sort of a lifestyle and a budget. In those instances, I don't think it's a bad idea to defer it, right? I think where the problem comes in is that for the last 15 years, nobody took their student loans serious, right? Nobody knew that the government could come and put them in a headlock and give them a dookie, right? They didn't know it. So the reality is now it's like, damn, right? I borrowed $200,000. I may have to pay it back, right? Because before it was just like, it's just a number that's so outlandish to some people, right?
That is true. And we've had customers that were going to go be doctors. And the next thing you know, I don't want to be a doctor no more. Like, really? 175,000.
I'll do you one better. And it's a occupation that has it all the time is attorneys. People go to school to be an attorney because everybody in school says doctors and attorneys. When you're in elementary school and high school, doctors and attorneys are, that's the epitome of success, right? Which I have my own opinions on. But the reality of the situation is that so many people aren't built to be an attorney. It's not like more than anything, because there's a certain personality that goes along with being an attorney. Not that there's anything wrong with attorneys, but the fact of the matter is, I'm saying that's an occupation where you see people go and go to school to be attorneys. They come out, they last like a year, right? Wow. And then they work themselves back into the corporate workforce and figure out a way to put that degree to work. But it's not practicing, right? You're just leaning on that degree, and you see it all the time. You're absolutely right. You see people. That's what I'm saying. Like, I would love, just for the sake, because I'm consumer friendly, I would love to see there be some kind of an underwriting that goes into these school loans, right? If you come in and you want to be, if your idea is that you're going to be a journalist, and the reality is the average journalist makes $35,000 a year, then maybe you shouldn't be borrowing $350,000 to go to NYU, right? I mean, maybe that's not the right school for you, right? I'm not saying you don't deserve an education. I'm saying that how on earth are you going to pay that money back? You understand what I mean? Like, there's no way. There's absolutely no way. There's no financial engineering that you can make over the course of, you could come into a lot of money, but just on a standard average scenario, you're making $35,000 a year and you have to pay back $250,000. How are you going to get there?
It's just like getting from a car loan perspective, instead of getting a Mercedes Benz or going to an expensive school, just get a used car. go to your county college.
But here's the thing, though. It's funny how you parallel with the auto loan, because it's the same idea, right? It's not a rational way of arriving at lending money, which you rarely see in society, right? Normally, when money's being lent, there's a very rational approach to it from A to Z. From the minute it gets instituted to the minute it actually gets lent out. When you see these two different products, there's absolutely no rationale. It's so reckless. And that's why the default rates are so aggressive that you know it's just a matter of time for something gives. So I would think, getting back to the original question, I would think that a certain amount of deferment and forbearance is good. Okay. I think where you start getting into a sticky situation is when you drag it out as far as you can in an effort to kick the can down the road, right? when I don't think that's technically necessary anymore, because if you don't make the money, they have these programs available to help so you don't have to wait. Because what ends up happening, whether it's deferment or forbearance, you add interest on top of that. So if you owe 40, right, you came out of school somehow recently and you only owed $40,000,
Yeah.
and you don't pay for 4 or 5 years, that 40 and that rate is approximately 5-6%.
Oh yeah.
Right? That 40 is going to be 60. Right? So because you're negatively amortizing that loan by not paying it. Yeah, you're not paying it, and yeah, you're still pays as agreed, but they add the interest because they're still paying themselves.
That's the other thing that you got a good point on, that people don't think. They just think, oh no, they're on deferment, and that's it. They deferment for 2 years. Yeah, they're in deferment. Nah, I got them in deferment. It's nothing. The next thing you know, why is it that on the credit report we get a whole bunch of student loans when we only have one? Do you have an idea?
Yeah, because it means it was funded by a bunch of different lenders within that envelope, right? So that means that, like, if it's a Department of Education, you have 6 or 7 different loans under the Department of Education. Sometimes you see it on the private side. You'll see like a bunch of different lenders that made up that loan, and they were all tranched out. That's why you see it spread out like 5 or 6 different times or 7. Sometimes you see it a lot more than that if somebody really borrowed heavily and they started to hit a problem.
Yes.
So they needed to really kind of dig for alternative lenders within the same envelope. That's why you'll see that. But that's why.
And the thing about those student loans is they only show maxed out. They don't show a limit to a balance.
Oh yeah. Well, no, no. Here's the problem though. They'll show what the original limit was or the original balance was. It's just nobody. It's rare to ever see somebody who's paid their student loans down. I mean, it's rare because you're paid. Because most of the time people aren't paying. If they are paying, they're paying a small amount relative to it. I haven't ever seen somebody in all the years I've been doing this. I haven't ever seen somebody pay like a significant amount, like thousands and thousands on their school loan. When it gets to that point, like a month, you understand what I mean? Like where they might have borrowed a couple of $100,000 and their payment's not like $2,000. They've always figured out a way to mute it, right? And because of that, there's like, in essence, you're not ever paying any principal down because you're not ever really paying the full amount. You understand what I mean? Like, you're not ever paying the full amount, so they're not ever going to apply it as a true payment where it's broken down in principal and interest. So you don't ever see that balance go down. It's just this endless pit of payments that people just hold their breath and hope that it's eventually going to get paid off. And I mean, I think the idea behind these new programs they're offering that they're giving people to, my thing would be work against their ratios, because their ratios, I guarantee, are telling them that for somebody to get into these programs for 10 years, 12 years, et cetera, 15 years, to where they get to the point where they can start forgiving it, I guarantee that they're thinking less than 5% of the overall population will even get to that point, probably less than that number. So my thing would be just fight them. Do it for 10 years. What do you have to lose? You save yourself money for 10 years, and then guess what? You'll save yourself more money. I mean, do the math on $100,000 loan. If you can get your payment down to $40 a month, that means you're paying $480 a year, and you do that for 15 years, right? You're paying roughly $6,000, and let's just say after that 15 years, they'll take that $100,000 and knock it down to 10, right? And you've only paid 6. Right, and you have to pay 10 more off. That means, in essence, you only paid $16,000 on $100,000 in loans. That's a gift. That's a dream gift. It's just they're not banking on people actually following through with it. And if people do follow through it, I think that you'd see these programs fall back. You know what I mean?
But check this out. Jay. But check this out, right? I got this Penelope who asks, so what happens if a parent disputes a Sally Mae student loan while their child is still currently attending college? What's going on with that? If the parent takes on that loan, but the kid is always going to be on that loan, correct?
Yeah, but that's a little confusing. First and foremost, Sally Mae is difficult. So I said that, I prefaced that earlier. They're one of the most difficult lenders. I fought with them for years with different clients of mine. They're just very, very, very difficult. They book their loans differently. They package their loans differently. They are the source of their own loans. So they are not flexible whatsoever about the modification stuff. They are not the best lender to be with. If you can avoid being with them, at least right now with the way the programs are, I would strongly advise. Now, she had said, based on what you just told me, she had said, is it okay to dispute the accounts, you said? Something like that?
Yeah. I'm thinking she's thinking, she's thinking, so can it still be removed? So what happens if disputes a Sally Mae student loan while their child is still currently attending college? I mean, the loan can still be removed, but the your child, they're still going to college. There's still a debt that they still have to pay.
Yeah, that even if it comes off the credit report, that's not going anywhere.
Correct.
The credit report is a third-party reporting agency. It's essentially an information system. So, I mean, that has nothing to do with the balance sheet of the institution. So whether it comes off the credit report or not is irrelevant relative to, at least in the the student loan scenario, is a debt that is still going to need to be honored and obviously taken care of. Or unfortunately, see, look, what happens is when the student loans get paid, like let's just say your kid goes to Rutgers and the first semester was $40,000 and they pay $40,000. Well, obviously your kid's covered for a year, right?
Yes.
So if you're the parent and you shouldn't be paying while they're in school, because you just shouldn't, because there's programs that that you can get out of that allow you not to pay till after they get out of school. But if for some reason you're forced to pay while you're in school, it's gonna be very difficult if you're not paying that loan while they're in school to get another loan. Sally Mae's not idiots. They don't keep lending if you don't pay. So, I mean, if it is a situation where they're out of school, or for some reason you're paying in school and it's not being paid, you're gonna have to look for alternative ways to try and get money for them to continue to go there, because Sally Mae's probably more than likely not going to be an option at that point. And with the history of the existing school loan, if it's not being paid, it's going to be something that's going to have to be addressed. But look, they can all be disputed. I mean, again, the disputing is a different. As long as you're not trying to suggest fraud within the context of the dispute, which could potentially cause issues, right?
Don't dispute with fraud. I love that term, fraud. What is the other term? The credit sweeps. No.
Yeah.
Don't do it.
They're synonymous, though, right? I mean, to a certain degree. I mean, in some ways, they're synonyms. But in that case, if somebody was to do that, you're obviously going to get to the department that's going to be reviewing. They're going to say, wait, this is fraud. Then potentially that kid being in school is fraud. So you don't really want to play that game if they're still in school or ever, quite honestly, with fraud, claiming fraud or whatever. I mean, you don't want to do that because you don't have to do that. But whatever the case, I mean, I as far as without knowing the specific situation, like to a T, I would say that, you can dispute it. But I mean, I don't know what the objective would be, because if they're still in school, you shouldn't be paying. So there shouldn't be any late payments on it. And as a result, it shouldn't be impacting, unless it's impacting the debt to income on the mom.
The mom, yes.
In her attempt to buy a house. And that would be, I think, the only nuance.
But that's what's going on a lot of times with these millennials. Their parents are paying for their they take out loans. And I get customers like that, where we are like, I put, I'm the what is it, the PG or the
the
joint
cosigner.
I'm in the cosigner joint on my student loans. I can't buy a house because of this, because my DTI is too high.
Yeah, I mean, specifically with Sally Mae, I actually had a client last year where him and his wife signed for the son for the last year's school through Sally Mae. And in doing so, they asked for the interest-only option. And for some reason, which we asked for a complete copy of the whole loan because it doesn't make any sense. I read the whole loan from front to back, and I still couldn't find it. They said because they chose interest only that they had to start paying immediately on it. And I fought with them for 8 months on it. I mean, literally, I read the entire loan from the beginning of it. It was like 60 pages. I read it from the beginning of the loan to the end of the loan and couldn't find anywhere where it said that. So this was obviously some sort of an internal scenario where if you're somebody that picks interest only on the Sally Mae loans, probably the Parent Plus loans, that you have to start paying immediately, which is ridiculous. Because, I mean, the kid's still in school, and, everybody knows why the parents are co-signing. They're not co-signing in most cases with the objective of trying to pay it back. They're co-signing with the objective of trying to get the kid in school, and then when the kid gets to the point that he can pay it, hopefully he can pay it back. So Sally Mae is just not the way to go if you can avoid it, in my opinion. There
you go. All right, so I have a famous question. I have student loans on my report that are closed. Can I remove them with the $99 do-it-yourself credit repair system?
you can, if you follow it to a T and you do what it says to do, and you don't try and rush through and ignore the pages that were put together. Without a doubt, that system can remove anything. It can remove anything that we remove. Okay, it just doesn't move as fast. That's the idea, because it's all done by paper, but the overall model is the same general idea. It's not the exact same idea, it's the same general idea, and it can do exactly what we do, just slower. Okay, it's going to be slower because it's all going to be mail. But if you're somebody that doesn't want to pay and you want the right system to work with and you're willing to read it, because I can't stress this enough. Okay, we have people that'll come with the $99 system, and they'll be like, "Oh man, I got like 70% of the accounts off. These last 20% have taken forever." And number one, congratulations on 70%. I don't know why you're complaining. And number two, we'll be like, send over a copy of the report and send us, the most recent template you sent,
Correct.
based on one of the rounds, right? The most recent round you sent out. We'll look at it, and it'll be missing just unbelievably important stuff. So in essence, all people I've seen, again, we've been selling the system since 2014. There's a lot of very intelligent people that do what they're supposed to do, and they have extreme success with it, and they go on to do whatever it is they want to do. Then you get a certain percentage of people that immediately rush right into things, and they just start with the templates. They cliff note all the content, right? It's like 15 pages of content that you have to read, which
Correct.
for most human beings at a normal age will take you about 10 minutes, right? So
Correct.
it's not like it's going to take you a month to read it.
Correct.
And it will, we advise constantly, both myself and Gizzy, read it a couple times.
Yes.
Soak it in. Read it every time you're putting a dispute together. There's nothing wrong with it. We did it for you to understand it.
Correct.
If I wanted to just give you templates, have no idea what you're doing, you wouldn't succeed at it, and then all you guys would do was complain in my ear all day long, and nobody wants that, right? We don't want that on the
Over
site.
5,000 systems sold. Imagine over 5,000 people emailing you every day.
No, I don't get 5,000 emails every day because people have a lot of success with it. You get certain situations where people, and then we have to welcome them. That's why we have the support team. That's why we give the endless, support. That's why we have the forum built in for people to see what others may have missed or exchange ideas and do all sorts of stuff. So I'm just saying that to answer your question, yes, you can remove them. Yes, people have removed. I mean, if you buy the system, we have a members only portion of the forum on the Credit Life site, and in that, we have every type of scenario. Clients, and again, these are all people that have purchased it over the years, purchasing all this, have the success stories in there where they've removed liens, judgments, public records, all kinds of child supports, etc. And this is all their personal experience with the system. This isn't,
Correct.
This isn't us interfering. This is them sharing and showing and trying to exchange ideas, etc. So yes, you can absolutely remove student loans. My suggestion would be, though, just because I just want it to be as easy and as much of an educating, because I'm all about empowering consumers, process, is go in and do it right. It's there for you. You have the gift in front of you if you get it. You can do it yourself. Read it, understand it, digest it, comprehend it, apply it, and then keep doing it until you're ready to go. But yes, it could definitely remove school loans without
We're
question.
going to have our own video just on the $99 system and how it works soon as well. So no worries on that. Yeah. All right. So so I have someone else that said, can you just remove a student loan so it won't show up on my report? Yes, we can. Or yes, you can too. I owe a lot and it's affecting my credit. I want to keep making my payments, but don't want it on my report because I'm paying minimum. And I mean,
so it sounds like they already went through the program.
Correct.
The modification of some kind.
Correct.
Which is good. So they obviously were proactive there, which is great, empowered themselves. But yeah, we can remove it. But they're obviously experiencing what we were talking about earlier, where they're making the minimum payment, but when they go for a mortgage, they're getting taxed at the larger payment, and it's completely blowing out their debt to income.
Okay. So I have another question, Jesse, which I probably already answered, but how does your payment plan work? You initially start the credit repair process and we pay as we go, or we make payments until your charge price is fulfilled and then the credit repair initiates?
No, we don't do payments. That doesn't ever work out. No. So, I mean, we've talked about this a couple of the podcasts that we've done over the last couple of weeks, but unfortunately, we've tried to work out payments, and it's largely been to our detriment. Whether we split out 2 payments, a multitude of payments, it always ends up being some kind of a story. Very small percentage of them actually materialize, and then we don't get to finish our job, which is the whole purpose of doing it. So we've determined over 10 years and 10,000 clients that the fee we charge is one fee. It's one time. That's it. We work until we're done. With that fee, we also walk you through the financing. We don't charge you additionally for financing. We charge you on the mortgage side. We don't charge you to get you car loans. We don't charge you. We haven't charged on the funding side, and I don't know how long. We walk clients through to get to their goals. We're goal-driven scenario. So you pay one fee, and that fee gets you in the door, and that gets you through to your goals until we're done, essentially. Right. So, and that's a situation that we've utilized now for quite some time, and it's been very good, and our clients are happy as a result of it. It's not always the cheapest number, but I got to tell you, paying it one time and the client knowing that they get it off their plate is a lot easier than slow bleeding them. We've heard more stories about clients getting so frustrated that they're 6 months into the process and they're still paying monthly fees or whatever the case may be.
Correct.
And they're mad that the process isn't far enough along or something like that because they went to a monthly company and this, that, the other thing. That's just not work. There's far too much work that is involved in doing this credit repair stuff on our end than to be arguing with clients. Okay, there's just not enough time in the day, especially when we're really getting people to goals. I can't speak for anybody else, but we are literally every single day almost helping clients achieve their financial goals. So I'm not going to sit and argue with you about a $90 payment that month. I'm just not going to do it. I'm not going to do it, and I shouldn't have to each month. If we're literally moving mountains for you guys when we're doing this stuff, we shouldn't have to sit there and explain to you every month what we've done up to that month. It's just not the process. Now, you absolutely deserve breakdowns each month. You deserve the progress that you expect. You deserve to get to your goals. We hold ourselves to a high degree of expectation and accountability. But the fact of the matter is, I feel like the monthly plan and the installment plan brings out the worst in the relationship between the credit repair company and the consumer. And it doesn't help to foster a cohesive, transparent environment that helps us get from A to Z. There's been more disruptions in that, whether it be the client not paying or the client having to pay slow, which ultimately slowed down the process, or them just not paying their back end. We talked about this before. We've had clients where we split out 2 payments as a courtesy, and they were going to buy houses and not paying us the back end. They said, wait till after we close. I said, wait till after you close. I mean, why on earth? You wouldn't even be closing on the house if we didn't even want to extend the terms. We extended the terms. We'd be arguing with them. They wanted to pay us after they closed on the house, which, by the way, who knows if the money would have even been there, right? Because a lot of people going to buy houses spend a lot of money, and then they got to spend a lot of money on the furniture. It's a very, very cost-intensive process.
The next 2 years is all on spending on the house.
Yeah, so trying to find that money after that purchase is, talk about diamond in the rough. It's a very difficult scenario. So to answer the question, unfortunately, we don't break out terms. We've tried. It's been a disaster. And over the years of trial and error, probably more than we should have, and trying every single way possible, this is the one way we've arrived at where, if for some reason the process takes longer, that falls on us because we price it out to a certain period of time. If it takes longer, we don't come back and ask for money. We get it done quicker. Obviously we make more money on the process. If we hit the number that we expect, we obviously hit it right on the head. But in those instances, it falls on us to finish. And, your financial obligation in the process is out the door from the day you start. You got nothing else that you have to pay into the process. And you basically we work together until we get you to your goals.
Correct. I got another question. Can you show us how to remove a repo? I think, the $99 system, you could remove the repossession.
Yeah, the $99 system can remove anything.
Anything.
So, it needs to be understood, just to be clear here. We get this repo question a lot, and I don't understand. It's like the student loan question.
Yeah.
There is not any special significance to a repo than there is to a BK, than there is to a mortgage, than there is to a child support. The significance that people hold in those accounts is the psychological significance that they place on it.
That's so true.
When it comes to us removing it, if you actually get the $99 system and you read the general premise behind our process and how we get accounts off, it's essentially the same way they put them on. It doesn't matter what kind of account it is or the size of the account. There's no creditors. If you have $1 million mortgage or a $10 million mortgage, okay, I have a lot of clients in Greenwich in the Stanford area. It just so happens it worked out that way. And there's clients that I've had that had 12, 14, $15 billion mortgages where they went bad on, okay? Or when the market collapsed back in 10, 11, 12, which happens, right? I'm not judging them. The point is, there's not somebody there at Chase Bank or Capital One Mortgage that are saying, man, we're not going to let this guy get away with it, right? It's just not going to happen. They're not going to sit there and fight you tooth and nail when when their market cap is trillions of dollars, right? I mean, it's part of the cost of doing business for these banks. So there's no special relevance to a repo. There's no special relevance to any of these accounts if you know how to get them on and get them off. The monetary amount doesn't matter. A $50 collection doesn't hold any more weight in regards to getting it removed than a $15 million mortgage does. It's just not any different. They come on to your report one way, and they all come on your report the same way. And they get removed the same way if you know what you're doing. So all these systems are run on algorithms. Again, I know I say this in every single one. I'm going to say it again. In the United States, there's close to 400 million people. As of 2018, they just updated it. As of the year-end 2018, Experian had 16,000 worldwide employees. Okay, that means there is no way that these credit systems are run anything outside of algorithms. Experian, Equifax has 10,000 employees, and TransUnion, I believe, has like 70-some hundred employees. Okay, so there's no way that there's even people there to receive your disputes. It's all done algorithmically. Correct. It's all done systematically. So there's absolutely, if you know how they put them on, then which we outline in the system, you know how to take them off. It's just not always that easy because they're all done, again, algorithmically. So it's a process, right? Sometimes you have to work around based on how you do it, and it's all outlined in the system, but it's all very clear. It's not like we're trying to sell you on some like pie in the sky stuff here. It's stuff we've used for 10 years, close to 10,000 clients. I mean, we're going to be having now, we're going to start doing these casts more and more and more. We're going to have more and more of the success stories, just not even going backwards, just the ones that are happening in real time. Correct. I mean, these are ones, these success stories aren't from people from years ago, right? These are all happening like in these weeks that we're providing them. And we'll continue to provide them. We'll continue to reflect them so you guys can see it in real time and really get a good grasp on exactly how consistent this process really is on a wide scale.
Correct. So I have Jimbo says, I got 77,000 in student loans. It will be higher soon. Can I get funding off that with a few primaries I have on my account?
I don't understand. Like, how do you get funding off of a student loan?
No. I'm thinking he's saying I got 77,000 in student loans. If I have some primaries that reported, can I still get funding as in credit cards?
I mean, there's so many other variables in that situation that need to be, in order, like, funding isn't just determined strictly off score. I mean, they use a ratio to arrive at a discretionary number, which that discretionary number gets backed into in a fully vested fundable number. So, for instance, if you're borrowing $25,000, the minimum payment on fully extended $25,000 is like $600. So you have to be able to back in off your income at a 40% multiplier to show that you still have $600 left over to be able to fit in there, right? Now, I know a lot of people just balloon their state and make up all kinds of numbers on the credit card applications. Correct. But I mean, there's more to that conversation, and we don't support that, by the way. But there's more to that conversation. I mean, if you have the income, right? If that $77,000 in school loans is a $900 payment, and you make enough income to be able to work off that multiplier and still have enough discretionary left over, you should be able to get funding. I mean, if you're talking about just regular unsecured funding, yeah. I mean, anyway, I mean, look, you can get mortgages if you have school loans. If you make enough money and you back into that ratio. Income. What's that?
It's all on income. If you make money,
it's completely based on. I mean, that's how they arrive at, like, the credit. I always say is credit gets you in the door, but the income determines how much you're going to borrow, and that's in every instance. Right? Like, that's in every kind of lending instance there is. The credit score walks you in the door. That gets you at a handshake. And then how much you make is what determines the amount you're going to borrow and the terms you're going to borrow on relative to the score. So, I mean, this is no different. So, I mean, I'd have to see if there's any negatives on if there's negatives.
No, I think he's the one that got a quote today from Michigan.
Okay.
He got a quote today. Well, he told me I sent him our how to start credit repair info. He sent his Experian info. That's what he told me. Hopefully. And
we gave him a quote.
And we gave him a quote, I believe. Yeah.
All right. So then, obviously, if that's the case, then there was obviously accounts that needed to be removed on there, because we don't quote accounts where there's not. So I assume the idea is that there's stuff that needs to come off first, which is understandable. And then after that fact, would he be able to get the funding? Because obviously, if you have negative accounts, if you're riddled with negative accounts, the last thing you want to do is pay to add trade lines or AUs. because they're not cheap and they don't stay on long, right?
Correct.
And then wait out the credit repair process and have to continue to pay for them until it's time for funding. So, I mean, there's a strategic way to do this stuff. There's a proper way to do it. But to answer broadly the question, once everything is clean and, you know, if you still have school loans on there and your income is good enough, you can still get funding. Yeah, I mean, that's not like a heel that eliminates funding, having school loans on there. Lenders don't look and say, wow, this guy's got school loans, we don't lend him $1. If the financials work, for sure. I mean, it works. It's just all the other variables have to fit. That's all.
I got a question here, but I don't know. It's kind of all over the place from Joshua, the person who had the student loan question. To clarify what he's saying, fight them for 10 to 15 years, question mark, but you said they're the best, but you said they are the best wage garnishers.
I didn't say anybody's the best wage garnisher.
Or if I can afford to pay it, my loan is $100,000. I can afford to knock it out in a year. Okay. What's the best move?
I'm not
pay
sure
it
I
or
said
fight
anybody,
it. No, I mean, go ahead.
I'm not sure I said any. I'm not sure. I don't the best wage garner. I'm not sure I said anything about that. I'm not sure I said any of that stuff. But I mean, if somebody has the money to pay the school loan off, there's probably better ways you can utilize that liquidity. If you can afford it, carry it, because you get to write off your student loan interest.
Correct.
So paying $100,000 off in school loans and chewing up that interest expense that comes off of your dollar for dollar, your personal income, would be crazy, right? I'm saying and number one, it's bad debt too. So if you want to pay off a better debt, pay your mortgage off. You got $100,000, pay your mortgage down. Open up a line off the back, and then you can write off the interest off that as well. So you can write off your student loan interest, keep paying that stuff like you should on terms that you should and appropriate. Take that $100,000 you just bragged about, put it against your mortgage, pay it down, open up a line of credit on the back, borrow against it as you need, and you get to write off that interest too. So, I mean, you got to be tactical about this stuff for tax purposes at the same time. But I didn't say about over anybody is the better, garnisher than anybody else. The purpose of this whole conversation is so that people don't put themselves in these positions.
Correct.
Is to avoid having to put yourself in that position. I hope nobody gets garnished. And that's why we're doing this, so that they can avoid getting garnished, because it's so simple to get yourself in these modified programs as long as you're not making money hand over fist and you don't have any debts. I mean, they're not obviously going to reward you if you make, $100,000 a year and have no debt and your only school loan is $1,500. You're not going to get rewarded for that. Correct. Right? They're not going to say, yeah, we'll lower your payment to $5. But if you're somebody that does what a majority of the people in this country does, is when you start to make a living, they lever up. And in doing so, it eliminates the amount that they can apply towards the school loans. That these programs that they offer are ideal for you. We can help you with them, or you can do them yourself. In any instance, the objective is to avoid putting yourself in a position where you get put in a headlock by the Department of Education. And, it's an uncomfortable position that a lot of people can't financially ride out on or get themselves out of. They normally need somebody that understands what they're doing as far as this stuff in order to be able to help get them out of it, so they can get back into a comfortable position, which can be avoided in the first place if you know how to.
Correct. Yeah. You guys got that? He asked another question. Excuse me if I'm asking too many questions. Do you offer a service that settles debt? Got some credit card, payday loans, and car loan. I'm afraid to do it myself because I know these guys sell debt to different collections.
I mean, we've helped clients in the past settle debt. Sure. I mean, again, look, there's not anything under the debt and credit related area that we can't assist or that we haven't assisted, to the correct extent. So sure, in a specific instance, we'd have to see the situation, but and how far along you are with the original creditor and how close you are to charge off, et cetera. Because there's a certain part of the process when you're with an original creditor, whether it's a credit card, an auto loan, et cetera, that is an ideal time to go in and try and settle, because, there's the front side of a creditor. And then once you get beyond the curtain.
Well, we spoke to a customer today, a future customer, was in a debt settlement program, right?
Yeah, but that's not, I don't think that's what he's talking about. I think he's talking about the guy asking the question. I think he's talking specifically about dealing directly with the creditor. I wouldn't advise. I think he's asking if you just settle debts directly, because there's no reason, in all fairness, I'm not trying to dump on any debt settlement companies, but there's really no reason in all reality to drag out 4, 5, 6, 7, 8 years or whatever the heck it ends up being and just torching your credit, when in reality, if you're not going to pay it and you get near the back end and you get near late stage charge off, you basically have the lender at their weakest.
Correct.
Because, at that particular point in time, they're at the borderline of either selling it off with depending on the size of the lender, $15,000, $20,000, $25,000, $30,000 loan, 30,000 other loans that are about to go in default to a collection company for 1 to 2, maybe 3 cents on the dollar. So if you start to come back there when they're about to sell, you have a very comfortable position. Now the delicate in the dance is finding it at that time, right? And knowing how to communicate with them and how to get it to that point. But going these long, unnecessary constraints, to drag it out and figure out ways to justify, your payment that you're charging the consumer, which ultimately isn't in the best interest of the consumer. I think people realize that, like the client today that we spoke to does, because they realize after a certain period of time that the only one winning in those situations, especially how long it drags out and how much they end up paying back, is the company. This guy was, what did he say? He was 2-3 years into it, and he's already paid back 40% of the total debt, and he has no end in sight yet. 40% is normally like a dream on a defaulted debt for a lender.
Correct.
If you get 40% back and you're a credit card company and you have a guy that went default and you got 40% back from that's a dream. That's not a gift. A gift is 10, 15%, right? 20%. That's a gift. 40% short's a haircut, but in reality, you're just working within the confines of the creditor themselves, knowing that they were going to turn around and sell it for 2 or 3 cents on the dollar. And now this debt settlement company just got them 40 cents on the dollar. My goodness, who are you working for? Right?
Correct. I know.
But to answer the question, yes, we can settle that.
We can settle that, yeah. So Joshua, he said, I have to call you because you're misunderstanding me. I gave him our email address. He could email us. We'll get to him. But I had the Penelope girl who asked a question about the student loans for her daughter or her son. And when we talked about fraud, don't file fraud, don't do anything, she's asking, what is disputing with fraud? You said not to do it. So
there's a multitude of ways of doing it. One of the lowest hanging fruit that consumers do that don't want to hire somebody else will just say it's not your debt.
Correct.
Because that's like, if you go to online dispute, you go to Credit Karma, any one of these avenues, there'll be the option, this isn't my debt. People just click on that because it seems the most obvious, right? And while you may get like 1 or 2 accounts removed, it ends up bubbling the account. So it rules out the most obvious aspect of it, right? It's so easy in this day and age to establish validity in an account because everything's done online, right?
Yes.
They can establish through the bank account that it's coming out of. They can establish through an IP address. There's so many different ways with technology now they can establish validity in debt. It's useless to even suggest that, right? You may be able to get a collection company over a medical collection for a multitude of reasons, none which will overall better the position of the report, right? But the other aspect that we're talking about with fraud is when people file fake police reports and fraud affidavits claiming that it was identity theft, which we certainly don't encourage, right? So that's the idea why we're saying stay away from it, because not only do you not need to do it, but more importantly, it could compromise the loan itself, which could potentially because it's essentially saying that you and your daughter didn't open it, right? Which could potentially turn around and compromise your daughter being in school. So, in those types of situations, you really wouldn't want to risk it if you don't have to, which you don't have to get it removed.
And we went over this question, I believe, in the first live feed today. Last week. So I'll link the video below. I'll put the video in the description of where you could see where we talk about why not to file with a police report or say that everything has been fraudulent. All right. Yeah. So so we're doing pretty good here, Jay, with Facebook. Live chat already on YouTube. 12 people there. A lot of them like the video. Please like and share the video. It's the best way to help us out. We've been already an hour 28 minutes. I just want to say Happy New Year to everyone. Thank you, Jay, for helping us out. Okay?
Yeah, you got it, man.
So, again, we have various services that we offer. You're looking for a mortgage. Is that correct, Jay? We help people position them to get mortgages.
We can, in any, it always starts in most cases with the credit, because in most situations, people that come to us need credit to get to whatever goal or goal-driven situations, right? And in a lot of cases, you may have student loan issues that come up, like we talked about earlier. They may have tax issues that come up that need to be addressed. All these things kind of work in the same envelope, right? Which is why we became good at them as well, because the reality of it is, in order to get to the goal, all this hair has to be pulled off. Some files are obviously much more complex than other files. Some files are very simple. They get in, they get out, everything lines up. They had a little bit of hair on it. We take it off and they go do what they got to do. And this is no judgment, but some files come in and they have every possible issue you could possibly imagine. They need to settle debts for any number of reasons. They do have tax issues. They have school loan problems. They have a bevy of credit issues, right? They have a lot of issues. And I mean, we can't just walk in and say, if we're running a legitimate company, and say, listen, we're only going to help the easy files. Everybody's on the crap file, the files that have the biggest problem, no judgment. You're going to have to go somewhere else. Because the reality is, I don't know anybody that, like, I'm not saying we're the only ones, but I don't know anybody that works in this many different areas effectively, right? Where you can effectively help somebody in the tax side, effectively help somebody on the school loan side, effectively help them properly sustain on the funding side and the mortgage side and the auto loan side and the credit side, et cetera, and make sure that they get under the right terms, under the right stuff in their best interest, right?
Correct.
That's why we like to control the situation, because we know we'll get you where you need to be and we'll do it in your best interest, as almost, like a fiduciary, basically in your best interest, with your best, our best intentions in mind, to put you in a situation that'll get you where you want to be. So I think the more we kind of try and impress upon that, and the more people understand that that's legitimately where it's coming from, and we've talked about this before, is that, when you're online, you just don't know the sincere intention. I know Gizzy's been posting videos for who knows how long.
10 years already.
He's got tons of videos out there, and as a result of that, I know people watch some of the videos and they probably have certain opinions about those videos, and we're trying to, provide more videos of more substance, like as far as like transparency, so you can see behind the curtain a little bit and how things work and how these clients get from A to Z. You don't just hear one small end story. We try to let you get an understanding of the knowledge of the people that are working on it, the extent of the knowledge, the degree of the knowledge, and then what exactly we're able to do. So you don't have to worry about, when you decide to get started, it's just let us run with it. You know what I mean? Let us run. Tell us your goals. We have an intake call after we start. We go over all this stuff as far as the goals and everything, and then we just start banging them out.
That's it.
Once the credit gets where it needs to be. So that's part of the reason, and we talk about it a lot, but it's part of the reason we're trying to do these more and more of these live casts, because it exposes a different side that I think a lot of companies don't show, because they
don't show. They don't know. They just want their monthly fee.
Yeah, and I think if you can differentiate yourself based on the true intentions of what the overall process is. Listen, don't get me wrong, we're capitalists. I've made that very clear before.
Correct.
But we're also our goal, though, and we wouldn't be in business as long. Our goal is to get the clients where they need to be. And that's just not rhetoric. We're showing it, right? We walk it like we talk it, and the reality is that you're seeing it. So we're going to continue to show it, and I think the more transparency, the more people will be comfortable, rather than, because one of the reasons is, without dragging this out too long, it's just the fact that we have a lot of people that will watch Gizzy's videos for a year, 2 years, and just still be hesitant because maybe there's just that element of the process that they just don't understand, or they haven't filled all the dots haven't, all the T's haven't crossed and all the I's haven't dotted in their mind. So, in an effort to provide more exposure to this and transparency, maybe it'll allow people to get more comfortable that have been waiting, or so they don't have to wait so long to move forward. They can know and understand that they're in good hands, and that the people that they'd be walking into are people that'll get them where they need to be.
That's right.
They can avoid that confusion.
All righty, Jay. An hour 32 minutes. We rambled and we educated, and we answered questions. I think next week we'll probably have another one or two. We have a whole bunch. There's a whole bunch of topics when it comes to credit repair, credit related stuff. John is, a real estate investor, does everything about financing a car, real estate investing. So you guys just shoot your questions away and John will answer them. All right, John. So, we're going to get some phone calls and some emails after this. So I guess I'll see you tomorrow.
Okay. You got it.
You got it, bro. Thank you.
All right. Yep.
Yeah. Take care. Mi gente, you already know. Thank you so much for logging on. Jesus. We talk. I'm telling you. You get this guy going, he goes. But, definitely happy that I have John on the team, because John is knowledgeable. And on top of that, he needs a platform. And that's why I put him here with you. So he's not hiding anymore the last 7 years of him doing this. I told him we need a podcast. We need to constantly educate you guys. So Curtis, everybody on Facebook, on YouTube, thank you so much. Love ya. Thank you for liking and sharing the video. Happy New Year.